Alrighty, folks, he's back. The one and only Taylor from Life Goal Investments, our 10-year Wall Street veteran who is gracious enough to come back every Monday when it's not Christmas or New Year's Day. So we appreciate that. We understand, Taylor. How you doing?
I'm doing great. I don't know if that was a warning or a celebration there.
Well, I'm happy to have you back. I love our conversations. We obviously have a very different background and experience, and I think the audience likes how we come at problems in different ways. So, why don't we just catch up on what the market is saying, right? There's been a lot going on, and by the market, I'm referring to the bond market, the Fed expectations for rate cuts. It has changed a lot over the last 3 weeks or so. I think we went from a peak of the market saying six, the Fed saying three. I think in that time frame, it went up, it came back. What is the market saying, now, if you will?
Yeah. So you're 100% right. There's been a lot of movement in rate cut expectations. What is the Fed going to do? How quickly are they going to start cutting rates? Has been the big question. And the backdrop has been volatile, right? I mean, at the end of last year, you had a massive run in basically every single asset class, which does not happen, right? You don't get stocks ripping, gold ripping, bonds ripping all at once. And it was kind of a confusing backdrop where it didn't matter. It was just people were trying to get money to work because they saw things just taking off. And we warned a little bit of this. Even you and I had the conversation that things would likely surge towards year end due to
Right.
some background Wall Street kind of nonsense that goes on behind the scene, for lack of a better way of putting
Mm.
that. And then we've seen a
We,
reversal to
we we
start this
call
year.
that window dressing. They were window
Window.
dressing their books.
That's exactly what happened. And we said
Yep.
it was going to happen, and it happened in spades.
Oh, I
And
did.
then start the new year, nothing changes really, right? But new calendar year, all of a sudden you get this sell-off that's starting to perpetuate here. And we'll see how long it lasts. But to your point, Michael, there was at the peak about 6 rate cuts priced into the market by the market. The Fed saying 3, the market saying 6. Right now, we're at like 5.5, somewhere right in that ballpark. So it's still dramatically further ahead than what the Fed is saying.
Yeah. One of the things that I thought was particularly confusing Friday, until you kind of get under the covers, is the jobs picture. Obviously, last week's was job weeks. We got JOLTS report, ADP report, which were both kind of soft in all the right ways. Then on Friday, we got Bureau of Economic Labor. The headline number was stronger than
Yep.
expected.
Yep.
But I'm sure you saw this. I think most people missed it. The ISM report that came out later, that was all kinds of bad.
Yep.
That prices paid, new orders, employment. It was that ISM report was ugly, ugly, ugly. So
Yeah, it
what's going
was.
on with jobs?
And we've had some of that in general with the ISM numbers. The manufacturing specifically has been brutal. ISM just basically measures how much manufacturing output we have on the manufacturing side. And then there's also the ISM that's for services as well. And services is what's held up so darn well throughout the past, 18 months, which is
Mhm.
what's kept the economy doing so darn well. The manufacturing has been struggling now for some time.
Right.
And so that kind of persisted to your point there. But the jobs market on an overall basis, it's been relatively strong. It keeps bucking the trend of we're going to see this massive rollover because the Fed raised rates so much, and that's going to eat through into jobs markets. It just hasn't really
Yeah.
materialized all that much yet.
When I look at those two reports, this is my non-Wall Street opinion of them.
Yep,
Right? Friday's jobs number is definitely a rear view mirror. It's probably the most backward looking report.
correct.
The ISM number is certainly more forward looking, in my opinion. So it could be the harbinger of pain to come. Is that a fair characterization?
I think it is. I think it is, but I also think that if you had been looking at the ISM number and being like, "Hey, this is a canary in the coal mine," the
Mm.
canary in the coal mine's been screaming for a long time
Yeah,
now,
he's
and you
still there.
yeah, you haven't seen the fire, start to break out yet. But to your
Right.
point, when it comes to unemployment, when it comes to jobs, et cetera, what happens is things are always really good until they're not, and then they gap
Yeah.
out. And so, like, you get this minor increment in uptick in unemployment, and then it blows out. And usually, the onset of a recession has the most muted unemployment number there is in the cycle, or darn near it, right? So maybe it
Yeah.
ticks up slightly, but then again, then it gaps out a 0.5% to 1% really, really quickly. And
Yeah.
so will we see that? That's still the big debate right now. If you look at the bond market, The bond market's saying likely we probably do, right? You've had the 10-year go from 5% all the way down to 4% seemingly overnight. And
Yeah,
that's been a crazy,
wild
crazy
moves.
move in such a short period of time. And that portends maybe the economy's not quite as on solid footing as the stock market is saying it is.
Yeah. Well, let's move to Thursday, right? We like to look ahead sometimes, and Thursday's a pretty big, certainly the biggest day of the week for economic data. That obviously is the day that we get the CPI reading. I'm sure you've seen it, but for the audience, expectations are 3.2 for headline, which will be up a tenth
Correct.
from last month. How important is Thursday, you think?
It's crazy because every time we see inflation, we're like, okay, this is the biggest inflation print we've ever seen before in our lives.
Mhm.
But it really kind of does seem to be that way. And now it's starting to fade a little bit and lose a little bit of its luster. But I
Yeah.
don't think it should be because listen, yes, we've had a massive reversion back downward in inflation. And by the way, downwards in inflation does not mean prices are coming down. It means they're going up more slowly. So
Yes.
let's leave that out there because I know people want to tar and feather me when I say inflation's coming down. They're like, what prices are you
Yeah.
staring at?
What planet are you on, Wall Street guy?
And I totally get that. I totally get that. But yeah, so I mean, inflation is tricky because what you've had is a massive rollover in oil prices. And that's been a huge, huge benefit of the inflationary numbers. And we'll see if that kind of continues. The oil prices have continued to kind of leak downwards. So that's still been a huge tailwind for inflation coming down. Now, we'll see again if we continue to get that pressured easing that we had when Russia invaded Ukraine, sent oil prices skyrocketing. There's still stuff going on in the Middle East right now that's really scary in the supply chain kind of
Mhm.
bottlenecks of the Red Sea and what's going on there. You now have shippers taking a long way around Africa, which is kind of crazy because that's input costs going up, etc. But in the short term, I do think that inflation kind of I think the target is probably on. If not, I wouldn't be shocked if it came in a little bit under.
Yeah, it's actually funny you bring that up on the daily financial news. And this morning, I actually put it out that I'm going to call 3-1. And I also
Okay.
took the time to call next month. I think next month, given the base effect, we're going to be sub 3%. It'll be the first number with a two on it in quite some time. So, think any of those calls are particularly crazy?
No, no, I don't think so. I think core is still coming down, but not to the magnitude
Hmm.
of headline because again,
Right.
one of the things in headline is oil. I
Right.
don't think oil is telling us one of two things. Like one is okay, US is now a massive producer of oil and we can kind of help dictate the price of oil around the world. And obviously it is to the benefit of our current administration in Washington to have oil prices be low in an election year. That's
Sure.
incredibly incredible. You can't overstate how
Yeah.
important that is in an
Yep.
election year. So that's one side of it. But the other side of it is okay, so the US can kind of increase production even when the Saudis and Russians are cutting on their side, and kind of maintain low oil prices because of that. The other side of it is like, or is this just saying that the economy from a global perspective is not that strong? Is
Yeah.
that what this is saying? Because if you have it, I mean, it's just a supply demand curve. And what it could be telling us is that demand is pretty darn low for oil right now, which is what's bringing oil prices down so much. Now, you look at the stock market and it's not reflected in stock prices by any stretch of the imagination. Stocks right now trade pretty much in the top 10 percentile of their historic norm from a valuation standpoint. So they're in the top 10 percentile of being rich or potentially overpriced. Now you don't know if it's overpriced to hindsight, but valuations on a forward price to earnings multiple are pretty darn stretched.
Well, let's go to kind of the elephant in the room for 2024, and that is the chances of this mythical soft landing where
Yep.
GDP never goes negative. We don't get a recession, maybe below trend, but positive. I think we talked over a year ago that we both thought it was highly unlikely. I think we were talking single digit probabilities. I know for me, the odds have gone up, but I haven't asked you in a while. What do you think the odds are of them sticking a soft landing in 2024 and avoiding a recession?
They certainly have come up, right? There's no doubt about it. I mean, what you've seen is a continuous drift downward in inflation and GDP remaining pretty darn positive. And now GDP does look like it's rolling over a little bit, but it's rolling over from a number that was 4.9%, which is
Yeah.
stupid high. So yeah, no, there's definitely increased possibility. Call it maybe 30%, somewhere in that ballpark. So I
Okay.
still don't think it's anywhere near 50%. And the thing that scares me right now is not that I think there's this economic collapse that's going to take place somewhere, something, like that. The thing that scares me is the way stocks are priced right now is
Mhm.
they are priced for a soft landing to take place. If the ideal scenario, which is the soft landing, doesn't take place,
Right.
stocks have downside momentum. And I think that that's what's being kind of not given its justice in the market right now is, again, at a 20-time multiple. That's like saying, hey, we're in expansionary territory. Let's go, baby. And when you look at a 20-time multiple, price to earnings multiple, the earnings are a forward forecasted earnings. They're being projected at almost 12% for S&P 500 companies next year. So for
Wow.
context, what that's saying is the Fed's dot plots. Now the Fed is not great at reading tea leaves. Don't
No,
get me wrong.
they're not historically horrible.
Correct. But the Fed dot plots, let's just take it for what it is, say sub 4% GDP growth in 2024.
Yeah.
And yet we're getting out near 12% in earnings growth, like 8% CAGRs or 8% delta between those two numbers don't generally play out. What that
Right.
means is, boy, they're going to increase margins a lot because the sales aren't going to, so at the end of the day, it's like, okay, they're at a 20-time multiple with an earnings expectation that's really high. And at the end of the day, that is pricing in like perfection. And so
Yeah.
you just have to be more muted in the expectation for forward returns in stocks.
Well, you do a lot of amazing stuff on your Instagram and TikTok. Where can people follow you? Because again, I can't believe the quality that you put out in those little short videos. What is it?
Oh, you're the man, Michael. Thank you for saying that. Yeah, check us out. We're at Life Goal Investments, plural, at Life Goal Investments, and putting out 60 seconds a day, something like that.
There you go. Great job.